I'd like to call to order the July 18th Montgomery County Employees Retirement Board meeting. Note the presence of all retirement board members. I'd like to have Treasurer Salas lead us in the Pledge of Allegiance. Yeah.
I pledge allegiance to the flag of the United States of America, to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all.
Okay. Do we have anyone for public comment? No. Okay. All right, approval of the minutes. I'd like to make a motion to approve the May 2nd, 2024 meeting minutes. Is there a seconded by Treasurer Salas? Any board comment? Hearing none, moving to a vote. All in favor? Aye. Motion carries. Invite Dean to do an overview of our employees' retirement system.
Yeah, I just wanted to quickly cover, we're going to be efficient in this meeting. I know there's one following this. And we have two presentations. First, SEI is going to give the investment performance review for Q2 period ending June 30, 2024. And then Corn Prairies here, we do an annual review of the actuarial valuation report once it's complete. That was done between the last meeting and this meeting, so they're going to go over high level the report and then some of the questions that have come up in recent months to address the coal and things like that. And then we'll finish. We have one action item, which is an amendment to the SEI investment management agreement. That'll complete the meeting.
Great, thank you.
So Kathy Parisi will come up first with SEI.
Good afternoon. How are you? Yeah, Michael. Hi, how are you? Hope you guys are having a great summer. So good to see you.
Hot one.
Yes, today is actually pleasantly a little bit better.
Oh, it's
It's only 80 degrees. It's all relative, right?
Right.
It feels wonderful.
It's only 80.
It's only 80. You can move this. So I'll be brief. I just wanted to go through the June performance, give you a little bit of perspective on what's happening with the markets. Feel free to ask questions, but I know you have a busy meeting. If you could turn to the executive summary. So I'm happy to report the next. The fund continues to grow. You can see since we were last together for the first quarter, the portfolio is up 1.44%. So you can see the top line there. We're still showing the SEI portfolio breakdown that the SEI portfolio was up 2.2% for the quarter, for the second quarter, and the Vanguard portfolio is up 1.34%. But if you look at the 1 year numbers, really strong growth. Portfolio continues to do well to achieve the goal of really increasing the funded status. So happy to report there. So you can see in my bullet points here, we equities and alternatives were the primary driver of the return for the second quarter. And also your year-to-date performance is 6.1%. So just looking quickly at the market value, you're up over 35 million in earnings year-to-date. So that's congratulations on, continuing to grow again with your goals in mind. I just have a few summary points here when we look at the attribution of that return for the quarter. You can see equities, again, a primary driver up for the second quarter, 2%, year-to-date 9.39%. It was a little volatile quarter. Remember, April was a pretty strong pullback month, really driven around what the Federal Reserve was doing. When the Federal Reserve pretty much came out and said inflation reports were really strong, we may not be cutting as quickly. There was even speculation as could there be a rate hike at one point. So equities across the board pulled back, but then we had a rally. So we ended particularly large cap. But I think what you'll find most interesting when you look at the equity market, and you guys see this every day, I'm sure in your interactions, it's really been those 7 key stocks, Magnificent Seven, the AI, mega cap, but primarily just NVIDIA. NVIDIA grew $1 trillion in 30 days. It's $1.8 trillion year to date. That one particular stock has really pretty much led the market. And I'll walk you through when you look at your large cap exposure. Obviously, the good news is those stocks represent a high percentage of your portfolio and are responsible, but I'll give you my point of view and outlook on that as well. Just looking at fixed income, we did see treasury yields continue to move higher across the board. They did pull back slightly at the end of the quarter, but that has really led fixed income markets to be flat pretty much. But you have exposure to other areas, diversification, shorter duration, high yield. You can keep on that slide one more second. And then high yield is really added diversification. And then finally, I would say the star, when you look at asset classes, has been your alternative exposures. Albeit they are a small percentage, but you can see here for the quarter, the alternatives were up just under 6%. Year to date, 12%. So your special situations, your hedge fund and your structured credit continue to bring that diversified source of return and really help the portfolio grow. And then we have inflation protection in there as well with exposure to commodities, which did well for the quarter. So if you turn to the market slide, I can further, this just give you perspective on the market before we look at your portfolio. So I spoke about large cap. You can see just for the quarter, your large cap, this is a Russell 1000, was up about 3.5%. So if you think of the Russell 1000, that's your top 1,000 securities. If you take those 7 names out, you know, we all know them, right? NVIDIA, Microsoft, Apple, Google. You take those 7 names out, that's negative. That just shows you the dramatic impact that these names are having. But you can see on a year-to-date, on a 1-year basis, the large cap continues to be the dominant performance and has benefited you all within your portfolio. Small cap was negative for the quarter, but I think it's interesting if anyone's following the markets the last couple of days, when the inflation reports came in June, that they had ticked down a little bit. Small cap has rallied about 9% in 5 days. So it's really, if you think about those small companies that are really refinancing and don't have access to credit, they're the ones that are doing really well now because of hopes of an interest rate cut. So you can see it was down for the quarter, but you know, it's definitely benefited your portfolio in just the last 5 days of over 9%. World equity was down for the quarter. Emerging markets was a surprise. China had a really strong quarter despite some really weak quarters of underperformance, but that rallied for the quarter. Again, my fixed income comments, you can see core fixed income flat for the quarter, long duration, you know, negative for the quarter, again, because yields continue to rise for the most part. You can see high yield bonds doing well for the quarter. You do have exposure to that in your SCI portfolio, as well as emerging market debt. And then finally, inflation linked and commodities continue to be diversifiers in your portfolio. They're in the SCI portfolio as well. They continue to have exposure to commodities, which have done well, especially precious metals. So again, if you look, you know, the theme on this page is diversification across the board. Equities have been leading, but as we look forward, it's important to have that diversification. I'll skip over the next slide, just really talking about yields within fixed income. I'll address it in my comments just to keep us on schedule. And then finally, if we think about, you know, SCI's point of view and what's happening in the market, and again, I know you guys are deep into this daily, but when you think about a number of factors that are driving the market, the economy, interest rates, inflation. So the economy is still strong. GDP did come down, you know, 3.4%. Now it's 1.4% first quarter, but still strong. Unemployment is still strong. Again, that has softened. We used to have 2 job openings for every unemployed individual. Now it's about 1.2. So we are seeing the economy soften. You're seeing job openings reduced. You're not seeing a ton of layoffs, which was with the fear, right? With the Federal Reserve high rates, you're seeing some of these openings come down, and that's really softening the job market. And then finally, inflation. Inflation is key on everyone's mind, especially the Federal Reserve, as they look to, you know, when they start cutting. We're seeing inflation come down, but SCI's perspective is we're a little concerned that it's not going to come down as quickly as everyone thinks. I mean, we've been getting some good reports. The last 2 reports came in a little bit more positive. We think there's a number of things that are happening. Services inflation continues to run high. We even think that we might get a little bit of an uptick in goods inflation. You're seeing concerns with the Red Sea, and we look at, you know, China export deliveries. We're starting to see that tick up a little bit. So we're in the camp a little bit higher for longer. We think the Fed will cut this year. Our initial outlook was maybe after the election. You know, I think with the most recent strong inflation report, the Fed may cut in September. And I think you can split hairs on when the Fed does cut. I think it's a matter of when will it happen and what will be the extent. And SCI's perspective on that is we probably don't think it will be as aggressive as the markets have hoped. If you think about, we started the year, markets were anticipating 6 to 7 cuts, which is crazy. We still haven't had one. Markets are pricing in probably 2 now. They're pricing in 6 through next June. SCI is in camp like a little bit slower. We think the 10-year rates will be higher for longer. Inflation will be a little bit higher for longer. And all of this, what does all this mean to you? We do have a fund within your portfolio, the Dynamic Asset Allocation Fund, which does reflect a lot of these rates and points of view of higher inflation, exposure to commodities due to higher inflation, points of view on interest rates, and how US Federal Reserve is acting versus Japan and Eurozone. So that's why I share all that with you to give you a perspective of what's happening. I'll spend 1 second on the S&P and the US market. One thing that we are looking at, and we are looking to keep you 100% passive in your equity allocation. I think we are continuing to look at that narrow leadership and that, lack of diversification, if you will. So we want to keep an eye on that. There will be a time, we especially look at NVIDIA, the volatility, it's priced for perfection. If you think about how well it's done, it's grown like the size of company, another company in just 30 days. So it's something that we're going to continue as your fiduciary partner to say, do we want to ever look at active management? Because that when you see that pullback, and we've seen it last couple of days, those mega cap names that pull back, the S&P is negative. So we want to keep an eye out for that. And then finally, we're going to talk about the asset allocation, but our goal is at the end of the day, we want to help you in your goal to increase the funded status, help with benefits, grow the portfolio. We do that in a number of ways. Asset allocation is first and foremost getting you diversification. We want to reduce volatility because you can't afford, we haven't had full market pullback in a very long time. And we want to have that risk mitigation, that control of volatility. And that's what we continue to look at when we look at your portfolio. So I'm happy to go through the funds, but you guys let me know how we are with schedules. If you want to just flip to the performance report, I can review it or we can skip it. The funds performance. Let's just move along. Yeah. Okay, great. Well, thank you very much. I appreciate the time.
So just one quick question, it's a point of clarification, is inflation's not coming down, it's not growing as.
It's not growing as much.
Right,
The
because,
inflation,
because when people hear it's not coming down,
yes,
it's growing at a lower rate.
price increases are
Right,
growing not as much.
right.
That's an excellent point. Everyone says like it's coming down. I don't see
So
that.
no, it's not coming down, inflation coming, yeah. Great.
Thanks, Tom. Appreciate that. Okay. Thank you.
So next up, Korn Ferry, they're gonna go over the actuarial evaluation report. I did provide a copy of it. It was issued on May 31st. We're gonna keep the presentation at a high level, addressing some of the questions that have come up from the board members. So with that, I'll invite the move further.
Hello, Michael Spadaro, Korn Ferry. So just for our roadmap here on the next slide, we have our agenda. Like Dean said, we're going to do this at a high level, get you up to speed. If there's a lot of pages in that report, we don't need every one of them to understand what's going on. That's why we're here today. We'll give you the main results, and then we'll talk about the COLA dynamic, because I know there was a lot of questions on that last time we were here. So jumping to slide 4. Why do we do this every year? What is the purpose of this funding valuation? So really it's 3 things. We want to track what happened the previous year, both on the demographic side and the investment side, because those are components that go into our valuation. We want to provide the status snapshot at 12/31/2023 when we do this valuation to say, here's where your liabilities for this plan are, here's where the assets are, and measure them together with a funded ratio, which is a general health measure for the plan. And then the big one is the funding needs of the plan, creating that actuarial determined contribution, or ADC, or what you're going to pay into the fund every year to keep this plan moving forward in a positive direction. Okay, so those are the 3 main reasons we do this. I'm going to dig into the actuarial determined contribution on the next slide, and what that is comprised of, and how we kind of calculate it. So there's 2 main components, the one being the normal cost, which is going to be your employees work another year of service. There's a cost every year to that service. You want to pay that and stay up to date. Then there's also this amortization payment where you're playing catch up essentially. So when we look at that funded ratio and we say, if you're not 100% funded, we need to catch up in some fashion. The amortization payment captures that shortfall from your assets to your liabilities. Okay. So again, we look at that membership information as a static date, 12/31/2023. We also look at the assets as of that same date. The one we care about on the actuarial side is the smooth value of assets. So market value of assets can be quite volatile. We do a process of 5-year smoothing to help dampen that impact and control the ADC's volatility. If we go to the next slide, we're gonna look at what kind of drives the ADC to go up or down, essentially. So these are the main things you kind of need to think about year to year, what could impact what's going on between iterations of our reports. So the biggest one ends up being the investment returns. Even though we smooth that out over 5 years, it still has an outsized impact on the fund. In 2022, returns were rather poor, and that happens. Sometimes we're going to be above our assumed rate, sometimes we're going to be below. But that year has an outsized impact, and when we get to the results, we'll kind of look at how that has contributed to the decline in the funded ratio ever so slightly. So even though we're smoothing, it still has a large effect, and that's why it's the first item on here. Okay. The other one is any kind of salary increases that are beyond our assumptions that we use. So for the plan, we use a 3.5% assumption. So every year we assume current employees get their pay is 3.5% higher than the previous year. If you give pay increases beyond that, it's going to increase the ADC. If you give pay increases below that amount, it's going to drive the ADC down. So really, these drivers are anything that deviates from the assumptions that we use. And then speaking of assumptions, if we ever change the assumptions, a lot of times we'll see a jump or a decrease in the ADC depending upon what it is. So the best example of recent changes is the mortality assumption. We changed that in 2022. So that had an increase in the ADC when we implemented that because we were moving to a later grader table where we were expecting individuals to live longer. But it's important, even though there is that short-term jump, it's really to allocate things better over time. That's our whole goal with assumption setting. So there might be some short-term pain by making an assumption change like that, whether it's lowering the investment return assumption or increasing the mortality experience. But the goal is to allocate the ADC over time more properly. If you're out of whack with the assumptions, you're going to be playing catch up. That amortization payment is going to be larger, and that's not our goal. Our goal is to get to 100%, and then it's really just the normal cost staying up to date with the current employees. Okay, so we kind of know what the ADC is. We know what moves it. What is in your control? So that's the next slide. As the retirement board, what are the things you can think about to navigate and maintain a stable ADC? So the first is assumption setting. So like I talked about, that is going to help us keep things smooth and less volatile over time. Investment returns are always going to create volatility. But if we have a return assumption that mirrors what we expect to be going forward, hopefully we minimize that. So same is true with any kind of demographic assumptions we use. The expected salary scale and the mortality assumption are the two big ones we think about when we're thinking about assumption setting. So that would be something you have control over at some point, and we have discussions on. The next bullet there, or set of bullets, is the demographic side of things. So if you give pay increases, like I said, beyond that 3.5% assumption or below that 3.5% assumption, that's going to trickle into the bottom line number, the bottom line ADC number that we present every year. Same way if you are filling up positions, like if you have a lot of new hires that are coming into the plan, it's not going to have an immediate impact on day one, but a larger staff, a larger payroll, because these benefits are payroll based and salary based, the cost, the bottom line number, that ADC is going to go up. So it's something to keep in mind that all the decisions you make, staffing the county and demographic wise, trickles into this plan and has an impact. So we wanted to just bring it to your attention so you're aware of it. And then the last set we have there is for any plan changes. So if the cost of the ADC goes up and is kind of out of control or in an area that is not tenable for budgeting reasons, the other lever you have is to change the plan. You can do that in two ways where you're situated. You can decrease the class basis or you can increase the number of contributions. Both of those have differing impacts. It would take a whole nother slide deck to get into it. But again, we want to make you aware of what you have control over as the retirement. Okay, so next slide, I'm going to get into some of the assumptions we think about. The first one is the investment return assumption. So we like to talk about this all the time because it is such a critical assumption. So we rely on the survey from NASRA, which is the National Association of State Retirement Administrators. They look at state plans across the country and do a good job of pulling together. What is the return assumption of these big plans, some of the leading plans in the country? So the median across the country for these plans currently is 7%. We're up at 7.5%, which is on the higher range of this spectrum when you look at these big plans. What is interesting to me is we've seen a trend to decrease that rate relatively recently, but in the past year or two, what I've seen from capital market expectations is that they've actually ticked up, where 7.5 doesn't sound too unreasonable with today's expectations, or at least the latest that I've seen. But this is a very fluid process. Just a couple of years ago, people were saying returns might be 6.5%. So in a 2-year span, this expectation changes. Our goal is not to move with that expectation exactly, but we have to be aware of it and think about if the 7.5 still works for us. So that's always going to be a constant discussion that we're bringing up and just making you aware of.
I'm sorry, I have a question.
Yes.
When you say compared to peers, is that the national assumption, or is that Pennsylvania, or is
So
that?
on the right there, that chart, that is a national poll. If we look in Pennsylvania counties, we have, from what I'm aware of in plans I work on, about 30% of them are at 7%, and then about 60% of them are above 7%. So within Pennsylvania, you're not totally out there. I know there generally, like I said, has been a push in the past, I'll call it 5 years, to lower this rate. The past couple of years, that push has been alleviated a little bit with what capital markets have been doing. Yeah, the future outlook. Does that answer your question?
Yeah, thank you.
Any other questions before I move on to asset smoothing, one of our other important assumptions and methods we use? All right, so that's on the next slide. So I mentioned we use this asset smoothing to dampen market volatility. The process we use is a 5-year smoothing process. And it's confusing how we presented the slide a little bit. There's only 4 years there. That is because we implemented this method in 2020. So we only have 4 years of gains or losses to smooth in. When we do this next year, we'll have the 5th year to evaluate as well. But what it basically does is it says how far above or below were you from our assumption. Okay. So if there's a gain, what we're going to do is we're going to take 20% of that gain. We're going to recognize it in the current valuation, and then 20% each year after until it's fully recognized. Same way with losses. So the idea is that we're not following that market value of asset, bounces around a lot. We keep it a lot more level and smooth. Okay. The dynamic we have right now, unfortunately, is that 2022 loss is weighing pretty heavily when you look at that compared to the other gains that we had in 2020, 2021, and 2023. So right now that loss has an outsized impact on how your asset performance is doing from a smooth market perspective. Again, the one we use for our valuations.
What drove that loss?
Sorry, what was that?
What drove that loss?
Market performance in 2022. I'd defer honestly to it was, yeah. Yeah. And so that's down 18% compared to we were expecting 7.5. Correct. Yeah, so that's down 20+%. And that's what we're factoring in here. So it was quite a hit, but it is not a unique situation for this plan. He's down. Okay. That's the case we're dealing with. Okay, so that $152.6 million is slowly being recognized. We've recognized 40% of it in this valuation. This 60% remaining will be in future valuations. So it has a little bit of a goofy effect. What ends up happening is even though you're contributing the ADC and moving forward and having very good practices, an outsized loss like that has a drag on the assets. So I think the next slide kind of shows that a little bit better graphically, at least for me to understand. So typically, when you expect asset growth, you think it's gonna go up a little bit every year unless you have a big loss, right? So we have an orange line that represents the market return. So we had 2 good years, then the drop in 22, and then a good year in 23 again, where it's bouncing back. So we see a lot of peaks and valleys, some volatility. The green line cuts between that, and that's the goal of using a smooth value of assets. We're always going to come back to the market value. That is the goal by design, but it happens over time. But the point I want to make is that even though we're doing well funding, we're contributing to ADC, that smoothing flattens that green line. And again, that is by design. It will work in the opposite direction if you had a lot of gains as well. It's really to make sure we don't have huge fluctuations in the ADC, because it would not have been pleasant to recognize that whole loss of one. So that's the situation we're in. Any questions about pensions 101, kind of what's going on? Then I'm going to jump into the actual results. Slide 12. We like putting the demographic information up on here. I'm not going to spend a lot of time on it. The one thing I do want to point out is that total annualized compensation number. Talking about if you're giving raises above 3.5%, it's going to trickle down into the pension plan. So that's something we saw between our 2023 valuation and our 2024 valuation. We saw a jump in that payroll. Okay, we go to the next slide. We have our bottom line number, the ADC. So that was $26.6 million this year. I think you are all made aware of this. That's in our report. It is up from $21.89 million the year prior. Again, we're recognizing those 22 losses. We had some salary losses because they were higher than expected. That all trickles in and contributes to the ADC going up. We would expect that stabilizes when we get to a more those investment gains and losses balance out a little bit more, and we have a little bit less fluctuation.
Based on that, how does say this, when I say new hires, I mean total number of employee growth, like
so if you're increasing the
headcount, yeah, thank you, headcount.
Right.
I was trying to think of, yeah.
So
if your headcount goes up, how does that impact this?
yeah, so it's going to be slowly over time for new hires. So when someone comes in as a new hire, they don't have any liability. They have no service, they have no history with the county. They start at zero from our perspective. So hiring a lot of additional new hires is going to up that normal cost. So that's that ongoing cost. And they start from scratch and we fund them every year with their normal costs. If we have a good set of assumptions, they should be perfect going forward. That's the theoretical concept.
But so the vesting works into that as well?
Yep, that's all worked into our assumptions, all the plan provisions and dynamics that goes through our software that we run to calculate all this. And the way this ADC is set up and the funding method, not to get too technical, it's supposed to be level pay throughout, or level percent of pay throughout their career. So the way it's set up, we give the ADC as a percent of payroll. If you were looking at just the normal cost, the concept is that percentage should not change. If we were up to 100% funded, your normal cost would just go up and down with how your payroll is. If everything worked perfectly, never does, but that's the theoretical thing.
You might be getting to it, but I don't see it in here other than the one reference on page 7. But can you talk about lowering the class basis and where our class basis is now and what compared to other
Sure.
counties if you have in Pennsylvania?
Yes.
And what that would look like going
So-
forward?
Yeah, absolutely. So we don't have any more of that in here. So it's a great time to take that question. So the class basis that you're on is the 160th class basis. That is the most rich benefit you can provide to county employees under the state mandated law for these plans. If you give me a second here, I did bring some statistics for you. You look across our client base, it's about 40% of counties are on that 160th basis. So it's fairly common. And then it's a general spread between the 170th and 180th. That's one tick down and second tick down on where the allowed benefits. It mandates you to choose the 160th, 170th, 180th, 1/100th, or 1/120th. So there's 5 options. Most counties, almost all counties are in that top 3, the 160th, 170th. Does that answer this?
Yeah,
Would I make
so
a
if we were looking to change that cost basis to 170, obviously it would be going forward for new employees.
Yes.
So it would be a slow change because the new employees would have to come in as new employees, be under 170, then a 160th, and then vest, right, and move
Yes.
forward. But is that something that other counties are looking to do, that other counties do, that people recommend? Like what's the?
Yes, so generally we have seen that. And it always comes up when the ABC gets a little too high. It's tough to manage, and we're thinking about what are measures that we can take to cut costs and make sure this is under control and doesn't get out of hand. So that is one of the measures that you can do, and we have seen before. You pointed out, though, it does take some time. That is the big caveat we put with changing the class basis, because it is just the normal cost that has changed. These people, new hires are coming in, but you can't change it for employees that are currently here. It's only that normal cost that will tick down over time. Now, over 20 years, it makes a difference. We've seen that, we've done projections that look at that. It makes a difference, but it takes time. It's not an immediate solution.
What would that process look like for, I mean, it would be a vote, or what would that process look like to make that change?
Yeah, it would be something that the retirement board approves, it has a motion that approves. We would always recommend looking at it numerically and doing a study of some sort to have some substance and back that up. So you have a well-informed decision on something like that. That's why I said it might take a whole nother slide deck for me to get through all the nuances of why to make that change, but that's something that we want to explore. That's why that's something we can help you with.
Okay, thanks.
Is there potentially, not, we wouldn't do it during a meeting like this, but maybe we'd set up like a seminar type concept where we talk about that, you know?
We would be open to that. I'm not sure about policies, but
Right.
Yeah.
Yeah, I mean, we're not making any decisions, you're educating what it could look like, you know, because I think that's a pretty detailed conversation that would require a lot of graphs, a lot of charts, numbers, but you know, I mean, that we ask questions.
Absolutely.
Yeah,
And it depends how in depth you want to
Right.
go. We've done ones where it's general and we say, hey, look at this projection, here's your trajectory, right? And here's how to think about that. If you're thinking about seriously going that direction, we're always going to recommend getting a formal letter from us, deep dive on numbers,
Right.
get exactly what you need to feel comfortable making a decision.
Right.
Any other questions before I jump to COLA discussion conversation? All right, so I think that's slide 16 that we're on. It's a couple more down. So I know this has come up before, so we wanted to throw a couple slides in here to make sure it's discussed. So every year we provide COLA information toward the end of the calendar year. Okay, so there's a specific consumer price index, CPI index, that we're mandated to use under state laws, and it's as of August 31st every year. So it's the same basis. We pull the number and we look at what is that impact on the plan if you were to grant COLA. So just for history sense here, the last one was 3.9%. Then it was 8.1% in 2023, and we have the rest of the history there if you want to see it. As of recently, we pulled the April number. Now, again, this is not the final. We have to wait till August. It was 4.1% as of April. Before we came here, they actually just released the June. So in between when we made these slides and now the June number is out, it's 3.6%. So to your point you made earlier, inflation isn't going down, it's slowing. I think that was the conversation right before I got up here. So we're seeing that in the CPI numbers that would be used for this calculation at the end of the year. Okay, the big thing to consider about the COLA is this plan will not be able to grant a COLA in 2025. There's a state mandated rule that says if you're below 80% funded, you cannot grant a COLA. So that will not be an option based upon our most recent results. Obviously, if that is of big interest to you, we will always be monitoring it for you and have conversations about it. Because one of the big things that comes to our mind is if we're waiting to hit that 80% threshold, we grant a COLA, it's gonna likely put us below the 80% threshold right after. Because it isn't a benefit enhancement, it's an increase in liabilities. So we have to be mindful of that dynamic.
But did that 78% change in August? This isn't a final 78%, or we are final at this?
The 78% funded ratio is fine. That is our report that we put out, the slide, a couple slides back.
The CPI is finalized in August.
Exactly.
So,
The actual CPI number is finalized later.
so last year it was 81%, so they could have did a COLA last year, is what you're saying?
Yes. But this year, and well, the upcoming year for 2025, we will not be allowed to.
But even at 81%, it was so close. That could have knocked us just to 80 or under.
Right, and that is the concern that we always have.
And I
from a
assume
plan.
as we contemplate a COLA, you do that projection to see where we'll wind up after the COLA.
Yeah, we can always do that, because what we do essentially is the next slide, when we look at these percentages. We look at what is gonna be the impact on the liability, and then how does that trickle down into your actuarial determined contribution. So we had the 4.1% numbers here and kind of some sensitivity to give you an idea. If you were to grant a 4.1%, again, we're not eligible to do that, but it's the hypothetical exercise for us. It would be an increase in $15.8 million to liability, which would knock us down. My quick calculation was like 1.5% of funded ratio. So just to give you an idea of what some of the magnitude can be by granting this. Again, it's a benefit enhancement. It is very valuable. I don't want to discount that for individuals, but it is a plan enhancement and benefit enhancement.
So when I look, I'm gonna jump ahead on your, I don't know, I got multiple handouts here. I don't know which one I'm looking at. The historical funded ratio, the assets liability slide.
Yep.
So there's the ABA funded ratio. which
You're
is
looking
the
at
green
slide
line.
14, correct?
Yeah, I guess.
Can you go back this one?
Yeah.
Yep, okay.
So. Wait a minute.
I can talk a little bit about the sliding.
Yeah, go ahead. Yeah, I was trying to follow this. Yeah,
Okay, yeah, so the, we have two lines here. One is the ABA, that's smooth value of assets that we use and utilize for the calculations for this valuation. And then the orange one there is the market value. You're always gonna know the market value because it's bouncing around a lot more, lots of peaks and valleys. So the market value is what is actually in the trust. So we measure in this graph, the funded ratio based on that volatile market value and also our smooth value.
so when I look at this, if I'm understanding this right, based on. What you're saying with the funded ratio from above with the 78.9%. It's slide right above that you went
Yep,
over,
yep,
right? So
78.9.
78.9%, and then last year's valuation was 81.3%. So when I'm looking at this, so the county could have done a COLA in 23, 22, 21, 20, 19, 18, 17, 16, 15, and so on and so on, as to why I'm reading this.
Yes, by the rules, yes, you.
Right, so what's causing this fluctuation from? Is it that loss in 22? But I know it doesn't make any sense. So we have in 19, it was 88.8, then it goes to 83.2, 83.9, like it's kind of fluctuating, and then we drop down to 78.9.
Yeah.
So is that the 2022?
So I personally would like to discount anything before 2020. That was under a different asset smoothing method. Which
Okay.
is what we would consider not actuarially sound. So that kind of inflated what the actuarial value of assets is. You can see that green line is above the orange line in all places. That is not ideal from our standards. That was something put in to help alleviate some of the losses in 08, 09. That kind of lingered for a little bit, and it's allowed under state law. But we've tried to move away from that from an actuarial practice.
So, all right, so we're just, if we ignore everything before 2020. So then this drop from 83.2 down to 78.9 is mainly caused because of the 2022 loss.
Yes. So you see, we were at 83.2. We had gains. It slowly ticked up to the 84.1
Right,
or 83.9, then 84.1, and then we got hit with a big loss. Right, so the point about the asset smoothing method that I find valuable is we dropped to 81.3 and then 78.9. But if we were using a non-smooth value, the real assets in the trust were less than 70% of liabilities. So we had this big loss that we're recognizing. You were under 80% in some kind of measure, not the measure that counts for granting these COLAs, but it is something we have to consider from a general plan.
right.
Standpoint.
So based on that mathematically, we could be 2, 3, 4 years out from actually getting back up over 80%.
Yes, yeah, unless there are some good returns in the next few years. I mean,
But it's gonna be good.
6.1%.
Yeah, but mathematically, to pick up that,
It's pretty
that-
good.
that's a huge loss in 2022. So it's gonna take time to grow those percentage points to get up to over 80%. It's not gonna happen in 1 year.
Yeah, that's.
Likely not, but I
Right.
can't predict the markets.
Well, no, I mean, well, likely, what I'm trying to do is set realistic because our retirees from this county hasn't received a COLA increase since what, 2009? What is it?
Yeah.
It's not acceptable. It's just not acceptable. It's poor planning on the county for the last 15 years. It's not acceptable.
So there is some history, and maybe you can help explain this a bit, because not everybody knows what happened with the plan in recent years, right? We had to implement the mortality table. We had to change the valuation method. The valuation method that you're
Yeah.
talking about was something that the state put in place when we went to the recession. There were a lot of plans that were underwater. So they offered up a valuation method, and it was meant to be a short-term thing, but I don't know about your other clients, counties or governments. I think for us, it was more of a longer term.
Yeah, we had a handful that stayed on longer term than maybe they should have, and we pushed for this new method to kind of get it in line.
I didn't mean to interrupt, but we had to stabilize the plan in recent years by doing some of these things that we did. We had to implement the mortality table. We had to change the valuation method to this 5-year smoothing, which is the more common method that everybody's using. And we had to get the ABC up to 100% our annual contribution. The board had a goal to do that over a number of years and achieve that. We're in year 4 of doing that with this budget. So they were all steps that were taken to try and get the asset value at a better place. And it's not easy, especially when you're implementing those things, right?
Right.
Well, and I can appreciate all, but the point of the matter is that we have people that dedicated their lives to work in Montgomery County that retired and haven't seen a raise in 14 years. That are living paycheck to paycheck as inflation is growing. And everything's going up, and we're not, as a county, not providing the proper, and we send out hundreds of millions of dollars all over this county for all kind of initiatives. And we are not properly in a position to ensure that our retirees who dedicated their life to Montgomery County are seeing any type of benefit. Growth and retirement. That's a problem. I have a real issue with that. And when looking at all these numbers and these graphs and all that, we're easily 2 or 3 years away if we're lucky. And that's if everything goes good.
You're just the messenger, so. That's something.
Standing here.
I'm not saying it's his fault. I'm just saying that in reality, people need to understand this is the position we're in. That's what I'm talking about.
No, and I guess what I'm saying, I think understanding that, look, I want to give our retirees a cost of living adjustment as well, right? Like, I'm with you on that. It's helpful to understand the historical context in terms of why we're at this spot. So maybe we can dig in a bit. I certainly appreciate where you're coming from. It's frustrating.
Yeah, so what I'll add as the messenger There are two competing components here that I'm saying, right? You do want to give retirees that benefit, that's valuable. I hear that. There was also a argument to stabilize the fund and get contributions up and get into a better funding position. And the argument I would make is that setting yourself up long-term is better for everyone. It hurts in the short term, absolutely. But if you don't stabilize this, there's no COLA in the future.
It wasn't until 4 years ago that we started properly funding. Like, so,
3 years, it's
'Cause
been
it
3
was-
full years, this will be the fourth year.
Yeah.
so like a decade ago, we weren't doing what we were supposed to,
No, there were.
and we're still reeling from that.
Going back to 2011, there was a time when there were zero contributions
Right.
to the pension fund. And then there was an effort to steadily increase those until we got into the ADC.
Right.
Which we
100% of
just,
the ADC.
Yeah, where we're at.
which we just got to.
Yeah.
And it took us how long to get to that point?
I don't know,
Since-
beyond,
12 years.
so, yeah, something else.
This report
Okay.
is 10 years, but, yeah, I know, but at least it gives them a snapshot. If you turn to page 6. That's the ABC calculation.
Yes. I mean,
There's a schedule of the contributions. It's a 10-year snapshot, but
Okay.
you can see what was calculated as the contribution that should have been made at 100%, and then what the county made. The actual contribution.
So it wasn't until 2021 that we were actually listing 101%. But
Yeah.
But my point being that unfortunately, this board now has to deal with the consequences of what this administration did from 2013, 13 years ago. That's unfortunate.
So we're trying to balance all of that,
Understand.
and that is a tough.
Okay. All right, we have another board meeting in 5 minutes, so thank you for being the messenger. And we will, looks like we'll have a more teacher discussion, so. All right, go ahead, Dean.
Yeah, the last item, agenda items, action item, and this is to amend the current SCI investment management agreement. We recall that the last amendment that was approved by this board was when we transitioned Vanguard's assets over to the management under SCI. SCI has put forth a new investment strategy proposal that's included in the resolution. It'll now structure the overall portfolio to be 50% passive, 50% active. The 50% passive investments are going to be 100% Vanguard investments, mostly in the equities. And then there's a revised fee schedule that has been included in the agreement. I have Kathy Parisi here if anybody has any questions in regards to the strategy or the new fee schedule.
So I'd like to make a motion to approve the resolution that Dean Dortone just presented. Is there a second?
Second.
Second by Treasurer Salas. Any board comments? Okay, moving on to the vote. All in favor?
Aye.
Motion carries. Any board comment? Hearing none, I'd like to make a motion to adjourn the. Hold on, let me get it up. The July 18th retirement board meeting. Is there a second? Seconded by Treasurer Salas. All in favor? Aye. Motion carries. Meeting adjourned. Thanks, everyone.